Hello and welcome. I'm Craig Harrington, and today's topic is the Treasury's lack of answers for the banking crisis. University of Maryland economist Peter Morici believes that Treasury Secretary Timothy Geithner's plan to fix the banking crisis is decimating private equity while generating fear among investors and not adequately addressing the root cause of the financial problem. He believes the root cause is the plummeting housing prices we've seen across the United States. Professor Morici wrote on tradereform.org that no solution to preserve private banking can be found without halting the freefall in housing prices. And he claimed that halting this freefall would require an aggregator or a bad bank to purchase up to $2 trillion in mortgage-backed securities from other banks. Instead of buying up trillions of dollars in mortgage-backed securities, the Treasury has instead decided to try to bolster balance sheets of banks through huge capital infusions. The Treasury has thus far committed $750 billion to boost the capital accounts of banks, but, according to Professor Morici, that simply won't be enough, as home prices will continue to drop at record rates. The money currently being sent into the banks is not being used to back up these devalued home assets, as it should be. It's being used for a number of other things which may simply stave off the collapse, rather than actually preventing it or addressing the real problem. Housing prices in the United States have continued to fall, and loan defaults, mortgage defaults, will continue to rise. Housing prices are down roughly 27% in the United States since August of 2006, and many experts expect future devaluations in the housing market of 15 to 25% before all is said and done. According to Morici, the outstanding mortgages in the U.S. total $11 trillion, and if housing prices continue to fall as expected, major banks could lose another $1 trillion due to accounting write-downs. To cover these losses, they will essentially liquidate all of the capital assets that they have remaining and will become insolvent. The insolvent banks would then require additional capital infusions from the government, and we would continue the cyclical waste of the Treasury and the Federal Reserve. Morici has also been very critical of Timothy Geithner's plan to test the health of the banking system through what he has called stress tests. And he's also been critical of the Secretary's decision to convert preferred shares in Citigroup into common shares. The conversion from preferred to common essentially wiped out all investors, and it gave the federal government a controlling interest in a now defunct institution. The stress tests and the shareholder blackouts give investors a reason to be afraid of private investment. This drives down stock prices even further and pushes the financial crisis deeper in the hole. Few capitalists are interested in a system where the government runs private finance, but these moves by the Treasury, coupled with the constant need from the banks for more government funding, has placed the government firmly atop the banking and financial institutions of the United States. The best solution for all interested parties, according to Professor Morici, is for the government to create a bad bank, an aggregator bank that would buy up all the bad assets being held around the nation. This would bolster the balance sheets of private banks and allow them to begin lending more freely to the American people. The bad bank could then rework the mortgages that it holds, saving perhaps thousands or tens of thousands from foreclosure and stabilizing the plummeting housing market. In addition, the bad bank would be able to provide taxpayers with the best chance of being repaid for the hundreds of billions of dollars they've invested in the financial system. The government has the ability to create money out of thin air, and it already has done so in part of its solution to the financial crisis. So there is no real problem of funding the bad bank. The only problem seems to be a lack of political will. If we just leave alone the mortgages that we expect to be repaid, and rework those that could be repaid with some adjustments on principal and interest, while foreclosing the rest, the aggregator bank, the government's bad bank, would simply leave alone those mortgages that it expected to be repaid. And it could rework the principal or the interest payments on those that could be repaid with some minor adjustments. The rest would simply be foreclosed. In doing this, the bad bank would fix the number of foreclosures in the United States, and thereby limit the fall in housing prices. Many thousands of mortgages would be saved. And the aggregator, like the government-sponsored Saving and Loan Crisis Resolution Trust of the 1980s, would likely earn a handsome profit in the end. And all of it could be financed with funds from the Troubled Asset Relief Program and private investments. We need to be concerned about the government's continued inaction in spite of the fact that viable options are available to them. The current policy measures have not helped stem the economic tide. We need a Treasury Secretary and an administration willing to change course and adopt new measures when their old policies fail. On behalf of concerned citizens, I'm Craig Harrington with economyincrisis.org News.
America, open up your eyes. Wake up, America, wake up.
Produced by economyincrisis.org.